All right, we've got the Craig McKay case study here now. Let's scroll down and read the first question. Question 1. ATCO Limited's debt-to-equity ratio, if all operating leases were treated as finance leases, will increase by 72%, 75%, or 108 or 109% if we round. So it looks like we're going to be looking at some financial information, need to convert these operating leases to finance leases, and then kind of consider what that does to the debt-to-equity ratio. Craig McKay just graduated from the renowned University of Michigan with a master's degree in financial management. As part of the degree program, McKay worked as an intern at Monarch Advisors, a medium-sized asset management firm, in the portfolio management department. After graduation, McKay planned to join the firm again as part of Mona's portfolio management team. Naomi Garcia, the head of Mona's strategy and investment planning department, invited McKay to a meeting. To ensure that McKay fulfilled the eligibility criteria for the job, Garcia instructed McKay to perform a comprehensive analysis of 3 firms: ATCO Limited, Uptel Incorporated, and YLS Tech Limited. After initial review of ATCO's financial statements showed that the company leased certain equipment under operating and capital leases. So that looks like we're getting towards the information we want to look at. McKay accumulated some information about the firm's lease obligations as displayed in Exhibit 1. So we've got ATCO and the leases. We're going to be looking at these capital leases and the operating leases. So what we're going to want to be doing is we need to convert these operating leases here into finance leases and then understand how that is going to change our debt-to-equity ratio. So our debt-to-equity ratio starting out is going to be this 880 over our equity. So let's pull that in first here. So I'm going to bring it up here. We've got a lot of stuff to bring in, so we'll try and make best use of our space. So our starting unadjusted debt to equity is just going to be liabilities over equity to start. So that's going to give us a debt to equity of almost 4, just under 4. And then, so from here, we're going to need to adjust our debt to equity for the leases and then run this calculation again. And so to make these finance leases, we're going to have to take out the interest portion of the lease, and then we're going to multiply that by the total operating lease amount to get our new debt amount that we're going to add to the liabilities. So let's pull in another part here that does that. So to get the principal portion of the lease, we're pulling out the interest. We just want to know what the principal is. We're going to take the $25,550, which is our minimum lease future payments, and then we're going to take out the interest, which we just talked about, which is that amount right here, and the current portion isn't relevant. So we're basically trying to find what ratio of our present value of future lease payments is principal and not interest. And then we're going to multiply that by the full operating lease amount. So that's the biggest difference between the finance lease and the operating lease. The operating lease is including everything, but the finance lease is just going to add this amount to to our liabilities. So the operating lease almost ends up being held as kind of an off-balance sheet liability, essentially. All right, so then from here, what we have to do is, all we really have to do is add this 697 to the 880, and then divide by the same amount of equity. The equity is not changing, we're just adjusting the numerator, essentially. So when we do that, let's pull in that number. So our new debt to equity, we've got the 880 plus the 679,295, divide that by the equity, and we get a new debt to equity of 6.754. So we started at 3.846, and now we're at 6.754. So now we just need to do one last simple calculation to figure out what the change was. So we're just basically doing this to figure out what the increase was. Brings us to 75.6% increase in debt to equity. And we scroll down and we see we've got that right here. Answer B. Question 2. Ignoring all other financial statement effects concerning the leased machine, the most likely effect on Finia's income before taxes on reporting the lease as a finance lease rather than an operating lease at year one end is that income taxes would be $3,800 higher, income before taxes would be $18,000 higher, or income before tax would be $17,000 higher. So I don't think we've heard about Finia yet, so we're going to likely have to do some reading here. And we left off at the exhibit, so let's start here at excerpt. So we've got excerpt from note 21, debt commitments and lease obligations. The company has taken several bank loans to fund the purchase of certain property and machines. The average interest rate on these bank loans is 8%. The current interest rate on finance leases similar to the ones ATCO has entered is 7.7%. To completely understand the effects of financial reporting of leases, McKay reviewed the financial statements of one of ATCO's lessors, Finia. So it looks like we'll be starting to learn some more about Finia and get the info we need. Finia recently leased a piece of machinery to ATCO with a useful life of 5 years and 0 salvage value. The present value of the lease payments is $200,000, which also equals its fair value. The annual lease payments amount to $43,860 each year. I'm going to just highlight that and this $200,000 because those are probably going to be numbers that we need at some point. And the lease contract calls for 5 such payments. Finia's discount rate is 11%. McKay was unsure how the classification of this lease as an operating lease or a direct finance lease would impact Finia's financial statements, which is pretty much at the crux of what we're looking at here. We wanted to know what the effect would be in these two different classifications for Finia. In addition, McKay discovered that just recently Finia dramatically increased its estimate of the discount rate applicable to determine the present value of its current lease receivables. During an informal discussion with Garcia, McKay presented the following observations. Looks like we've got all the information we need here. So Finia is leasing to ATCO. And so in a finance lease, the lessor is going to recognize interest revenue based on the lease receivable, which is going to be the present value of the future lease payments. So we're going to need to calculate that amount, and let's go ahead and do that first before we kind of get to the operating lease part, which is going to be a little more complicated. So the financing lease portion is going to be pretty easy. Like we said, it's going to be interest revenue, which will just be the interest rate times the present value of the lease payments. So our discount rate's 11, and $200,000 is that present value of lease payments. So the interest revenue that Finia would be reporting under this will be $22,000. So under an operating lease, then, the lessor does not recognize a lease receivable, but instead recognizes lease income evenly over the lease term. So I'm going to scroll a little bit here just so we have some more room, and then I'll bring this down as well. Oop. Sorry about that. Let's bring the financing lease information down, and then we'll bring in the operating lease information. We'll scroll up as we need to, just so we have enough room. All right, so for the operating lease, here's how we're going to kind of calculate this. So we've got the annual lease payment of $43,860. I think we highlighted that up top at the beginning. So then under this approach, we're going to be recognizing depreciation expense, which is going to be our $200,000 divided by 5, $40,000. So we know that because we have a useful life of 5 years and 0 salvage value. So we're basically taking that $200,000, we're depreciating the whole thing right down to 0 over that 5-year period. That gives us our depreciation expense yearly. And so under this approach, our income before tax is going to be that $43,860 minus our depreciation expense gives us $3,860. In this case, that income before tax is $22,000. So the last step we need to do is just take the difference between the $22,000 and that 3,860, which I have right here. Let me just pull this in. So when we do that, we get 18,140. Leads us to answer B. Okay, question 3. McKay is most accurate concerning observation 1 only, observation 2 only, or both observations 1 and 2. So we left off reading right here. So it looks like we're right at those observations. So we'll read observations 1 and 2 and determine which ones are accurate. Observation 1, the interest rate that equates ATCO's minimum future minimum lease payments with the present value of these payments is 10.5%. Since this rate is much higher than the current rate on capital leases, ATCO is most likely opportunistically reducing the present value of its finance leases and thus its reported debt. So typically the discount rate is going to be determined by the credit rating of the lessee and not market rate conditions. So it's likely not manipulative behavior. They're probably not opportunistically reducing the present value. They may just have a lower credit rating than the market rate, so they're being charged, or so they're using a higher discount rate. So observation 1 is probably not accurate. Let's take a look at observation 2. The dramatic revision of the discount rate used to determine lease receivables suggests that Finia might be trying to increase profits shown in the current year's financial statements, and analysts should carefully determine whether such a revision is justified given current market conditions. Yes, it's always a good idea for an analyst to take extra steps to look at something like this, because raising that discount rate is going to lower the present value of future lease payments, leading to higher profits in the current period, and they want to make sure that this revision is justified. So sounds like observation 2 is correct, observation 1 is inaccurate. So we're most accurate concerning observation 1 only, nope. Observation 2 only, yes. Both, nope. So we'll go with B. Question 4. Based on the information McKay has gathered, which of the following is most accurate? Uptel appears to have a lower percentage of assets tied up in inventory than YLess. YLess appears to have a lower percentage of assets tied up in inventory than Uptel. Or both Wiles and Uptel have comparable inventory management efficiency. So it looks like we're going to be comparing these two companies, Uptel and Wireless, and then understanding how much of their assets are in inventory. So let's scroll up to where we left off. We left off after observation 2, so we'll start right here. McKay proceeded with an analysis of Uptel and Wireless, which is the companies we're looking for. Both companies operating as suppliers in the technology sector. Uptel uses the FIFO method of accounting for its inventories, and Wireless uses the LIFO method. For a comparison of their inventory management techniques, McKay selected the following information about the two companies. So we've got financial information for Uptel and Wireless. We've got inventories for both, and we've got total assets for both. So on a straightforward basis, this looks pretty simple. Like we're just going to do inventories over total assets. However, key here is Uptel uses FIFO and Wireless uses LIFO. So we're going to need to adjust one of these we're going to need to adjust one of these companies to either the FIFO or the LIFO method in order to kind of compare them apples to apples rather than apples to oranges. So let's look down here. If Wireless used the FIFO valuation method, reported inventories would have been 6,700 million higher. Sorry, I read that wrong. This is in millions, so 6,700 higher in 2008 and 5,500 higher in 2007. Wireless's COGS include an amount related to inventory write-downs. The valuation allowance in year 2008 increased slightly relative to the previous year. So it looks like we're going to just be doing the simple calculation for Uptel, and then based on the information they gave us, we can adjust wireless tech from LIFO to FIFO and then compare those two ratios. So for Uptel, let's just get this out of the way since it's a little quicker. Oh, I've got it in the same box. So we'll just walk through both. So Uptel, we're going to be doing that 18,300 over the 95,200. Pretty straightforward, gives us a inventory over assets ratio of 0.1923. So then for wireless, what we're going to be doing is we're going to be adding that 6,700 amount to 2008, since 2008 is the year that we're looking at. And that gives us our numerator for inventories. And then in the denominator, we're going to be taking 65,000 plus the 6,700. However, we do need to adjust it for the tax rate because those inventories would have been sold. And so that's going to leave us to a 0.237 inventory rate. So let's see. Uptel appears to have a lower percentage of assets tied up in inventory than wireless. That would be accurate after we adjust them both for FIFO. So we will go with answer A.